If you're dreaming of early retirement, congratulations on taking control of your financial future. But before you hand in that resignation letter, there's one critical piece of the puzzle that can make or break your early retirement plans: health insurance. Today, we're diving deep into the different strategies to pay for health insurance if you retire before age 65, when, of course, Medicare kicks in. And trust me, this is information you absolutely need to know. This gap between early retirement and Medicare eligibility, it's often called the health insurance gap, and it's one of the biggest financial hurdles early retirees face. The good news? There are multiple strategies to bridge this gap, and I'm going to walk you through each one so you can make an informed decision that fits your specific situation. Let's start with understanding the challenge. When you retire early, you're stepping away from employer-sponsored health insurance that likely covered 70 to 80% of your premium costs. Suddenly, you're responsible for the full cost of health coverage. We're talking anywhere from a few hundred to several $1,000s per month, depending on your circumstances. Here's a reality check. A 65-year-old couple retiring today will spend approximately $315,000 on out-of-pocket medical expenses during retirement. But if you're retiring at 55 or 60, those costs start to accumulate years earlier. And without Medicare to help, the financial burden can be substantial. Let's talk about your first strategy, Cobra coverage. The immediate bridge. Cobra stands for the Consolidated Omnibus Budget Reconciliation Act, and this is often your first line of defense when leaving an employer. Here's how Cobra works. It allows you to continue your employer's health insurance plan for up to 18 months after retirement. In some cases, you might even get up to 36 months of coverage if you experience another qualifying event like divorce or if you become eligible for Medicare during the Cobra period. But here's where it gets expensive. While you were employed, your employer typically covered 70 to 80% of your health insurance premium. With Cobra, you pay the full premium plus a 2% administrative fee. This means if you were paying $500 per month for health insurance while working, your actual Cobra cost could be $1,500 to $2,000 per month or more. When does Cobra make sense? It's ideal if you're retiring close to age 63 and a half, giving you just enough time to bridge Medicare eligibility. It's also valuable if you have ongoing medical treatments with specific providers because you maintain the same network and coverage. Now, let's talk about strategy number 2, ACA Marketplace plans, the flexible option. The Affordable Care Act Marketplace offers some of the most flexible options for early retirees, especially if you can manage your income strategically. The key to making ACA plans affordable? Understanding something called Modified Adjusted Gross Income, or MAGI. Premium tax credits are available for individuals earning up to 400% of the federal poverty level. That's $62,600 for a single person or $84,600 for a married couple in 2025. Here's where it gets interesting. As an early retiree, you have unique flexibility to control your MAGI. You can withdraw from a Roth IRA contributions, which aren't counted as income. You can manage the timing of Roth conversions, control taxable investment income, and spend down cash reserves before tapping retirement accounts. Let me give you a real-world example. A couple earning $50,000 in early retirement could receive premium tax credits of $1,300 per month. This reduces their monthly cost from $1,800 to just $500. This makes ACA plans one of the most cost-effective options for many early retirees. But here's something important to keep in mind. Enhanced ACA subsidies are currently set to expire at the end of 2025. Without these enhancements, higher income early retirees, those earning over 400% of the federal poverty level, would lose subsidy eligibility entirely and face significantly higher costs. Strategy number 3 might be your best deal. Spousal coverage. If your spouse is still working and has employer-sponsored health insurance, joining their plan is often the most cost-effective solution. Here's how it works. Your retirement qualifies as a qualifying life event, allowing you to join your spouse's plan outside of the normal enrollment period. You typically have 30 to 60 days to enroll after your retirement. What about costs? Adding a spouse to an employer plan typically costs $200 to $600 per month, depending on the employer's contribution and how they pay for that. Some generous employers may add spouses at little to no additional cost, while others may charge the full additional premium. Here's a planning tip. If you're married, coordinate your retirement timing with your spouse's employer's plan year and benefit structure to maximize savings. Strategy number 4 is becoming increasingly rare, but it's worth mentioning. Employer retiree benefits, the rare gem. Some employers offer health insurance benefits to retirees, though this is becoming less common. The numbers tell the story. Only 21% of large employers offered retiree health benefits in 2023, down from 66% in 1988. Among those that do offer benefits, many are shifting to Medicare Advantage plans for Medicare-eligible retirees. If your employer offers retiree benefits, review whether the employer subsidizes premiums, coverage details, and network providers, whether benefits continue until Medicare eligibility, and any waiting periods or service requirements. Here's an important note. Private sector employers are not required to provide retiree health benefits, and they can modify or eliminate these benefits unless they've made specific promises in writing. Strategy number 5 is for lower income early retirees. Medicaid. Medicaid can be an excellent option for early retirees with limited income. In most states, Medicaid is available to adults under 65 with income below 138% of the federal poverty level. Now, that's approximately $21,597 for a single person, or $29,187 for a married couple in 2025. Medicaid has both income and asset limits. While retirement accounts are generally counted as assets, there are strategies to potentially qualify, such as putting retirement accounts into payout status. The coverage quality, well, Medicaid provides comprehensive coverage with little to no cost share, though provider networks may be more limited than other options. Strategy number 6 deserves special attention. Health savings accounts. The triple tax advantage. HSAs deserve special attention in early retirement planning because of their unique tax advantages. The triple tax benefit, triple tax deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. So HSAs become particularly valuable in early retirement because you can use HSA funds to pay for health insurance premiums if you're receiving unemployment benefits or continuing coverage under Cobra. After age 65, HSA funds can be used for any purpose without penalty, though non-medical expenses are subject to income tax. And HSAs have no required minimum distributions, allowing continued tax-free growth. Now, I often encourage my clients to maximize HSA contributions during their working years. If they don't have many medical expenses, the HSA can grow for retirement. Strategy number 7 has gained popularity recently. The Barista FIRE approach, health benefits through part-time work. Barista FIRE has gained popularity as a way to secure health insurance while maintaining some income. Here's how it works. Work part-time, typically 20 to 30 hours per week, for an employer that offers health benefits to part-time employees. This strategy gets its name from Starbucks, which famously offers health insurance to employees working 20 plus hours per week. Companies known for offering health insurance to part-time employees include Starbucks, 20 plus hours per week, Costco with part-time benefits available, UPS for part-time package handlers, school districts for bus drivers and custodians, hospitals for various part-time positions, and some retail chains like Trader Joe's. Barista FIRE provides both health insurance and additional income, potentially reducing the amount you need to draw from those pre-tax retirement accounts. It's particularly attractive for those who want to stay somewhat active in the workforce. Okay, now let's talk about strategy number 8, health sharing plans. the community approach. Health sharing plans, also sometimes known as healthcare sharing ministries, offer a unique alternative to traditional health insurance that's particularly attractive for early retirees without pre-existing conditions. Here's how health sharing plans work. Members contribute a monthly share amount into a communal funding pool. When a member has a medical expense, they submit their bills to the health share, and the community shares the cost based on the health share's guidelines. The financial benefits are significant. Health sharing typically saves 40 to 50% per month versus the unsubsidized cost of traditional health insurance. For early retirees who don't qualify for ACA subsidies, this can represent savings of hundreds of dollars per month. What makes health sharing particularly appealing for early retirees? First, you have complete freedom to choose your healthcare providers. No network restrictions. Second, you can enroll at any time during the year, not just during open enrollment periods. Third, many health sharing plans offer additional benefits like telehealth services, prescription discounts, and even dental and vision discounts. But here's what you need to know about eligibility. Many health sharing plans are faith-based organizations with specific lifestyle requirements. Members typically need to agree to a statement of beliefs, abstain from tobacco and illegal drugs, and maintain a healthy lifestyle. Some plans require regular church attendance, while others are more flexible with the requirements. There are more health sharing options available today that are not faith-based, such as Zion Health Share and New Health. Regarding pre-existing conditions, health sharing plans handle these differently than traditional insurance. Many plans accept members with pre-existing conditions, but typically impose waiting periods ranging from 1 to 3 years before costs related to those conditions become fully shareable. However, some plans offer exceptions or waivers for certain conditions, especially if they're well controlled or haven't required treatment for several years. The key is understanding that health sharing plans are not insurance. They're a community-based approach to sharing healthcare costs, and this means there's no guarantee of payment, but the major established ministries or programs have strong track records of sharing eligible medical expenses. Over 1.5 million Americans currently participate in health sharing plans, with many early retirees finding them to be an excellent bridge to Medicare eligibility. Let's also mention some alternative options, but proceed with caution. Several other options exist, though they come with significant limitations. Short-term health insurance offers lower premiums but limited benefits and may not cover pre-existing conditions. They're typically designed for temporary coverage gaps, not long-term solutions. And geographical arbitrage, moving to areas with lower health insurance costs, can provide savings, though this requires careful research into local provider networks and costs. Now, let's talk about strategic planning considerations. Your modified adjusted gross income, or MAGI, determines your eligibility for ACA subsidies. Strategic management of retirement account withdrawals, Roth conversions, and investment income can significantly impact your health insurance costs. Timeline planning is crucial. Gotta map out your health insurance strategy from early retirement through Medicare eligibility. For example, years 1 through 2, spouses coverage. Years 3 through 5, ACA Marketplace with subsidies or health sharing plans. In year 6, you transition to Medicare. Geographic considerations matter. Health insurance costs vary significantly by location. Some early retirees relocate to states with more favorable ACA marketplaces or lower overall health costs. Emergency fund planning is critical. Prepare your emergency fund to account for potential health insurance gaps or unexpected medical expenses. Many experts recommend 12 to 24 months of expenses for early retirees versus the traditional 3 to 6 months. Let's talk numbers. For planning purposes, consider these rough annual estimates. Single person with employer coverage, $10,000. Single person with ACA Marketplace coverage, $8,000 to $15,000. A single person with health sharing plan, $3,000 to $7,000. Now, a married couple with ACA coverage, $15,000 to $25,000, and a married couple with health sharing plan, $6,000 to $12,000 per year. Cobra coverage, the big one, $15,000 to $30,000 annually. Don't forget additional costs. Beyond premiums, factor in deductibles, often $3,000 to $8,000 for individual plans. Co-payments and co-insurance, out-of-network costs, and prescription drug costs. How do you make your decision? Choosing the right health insurance strategy depends on several factors. Your timeline matters. Retiring at 62 to 63? Cobra's an easy but expensive bridge to Medicare. Retiring at 55 to 60? ACA Marketplace, health sharing plans, or spousal coverage are likely better. Retiring very early, under 55? Consider the Barista FIRE approach. Your income level is crucial. Lower income? Focus on ACA subsidies or Medicaid. Higher income? Health sharing plans, spousal coverage, or employer retiree benefits. Variable income? Plan for income management strategies. Your health situation matters as well. Generally, healthy without pre-existing conditions? Well, health sharing plans can offer excellent value. Ongoing medical needs? Prioritize comprehensive coverage like ACA plans. Chronic conditions? Avoid short-term plans and consider the waiting periods for health sharing plans. Your family situation is also important. Married with a working spouse? Well, obviously spousal coverage is often the best. Single? Maybe ACA Marketplace with subsidies or health sharing plans may make sense. Do you still have dependents? You will need to factor in family coverage costs. Here are your action steps for your early retirement health insurance plan. First, assess your current coverage. Review your employer's retiree benefits and Cobra options before retiring. Second, calculate your MAGI. Work with a financial advisor to project your retirement income and potential ACA subsidy eligibility. Third, research your options. Get quotes from ACA Marketplace plans. Investigate spousal coverage options. Explore health sharing plans. And look into Barista FIRE opportunities. Fourth, build your health fund. Maximize HSA contributions while working and build additional cash reserves for health expenses. Fifth, plan your income strategy. Develop a withdrawal strategy that optimizes your health insurance costs throughout early retirement. Sixth, consider geographic factors. Research health insurance costs in your desired retirement location. Seventh, review annually. Health insurance options and costs change yearly, so plan to reassess your strategy each open enrollment period. Here's the bottom line. Health insurance in early retirement doesn't have to be a deal breaker for your financial independence. With careful planning and the right strategy, you can secure quality coverage that fits your budget and lifestyle. The key is starting your planning early, understanding all your options, and being prepared to adapt as circumstances change, because they will. Remember, the health insurance landscape is constantly evolving, especially with potential changes to ACA subsidies and Medicare eligibility. Stay informed, work with qualified professionals, and don't let health insurance fears prevent you from pursuing your early retirement goals. Your early retirement journey is unique, and your health insurance strategy should be too. Take the time to evaluate these options carefully, run the numbers for your specific situation, and create a plan that gives you confidence in your decision to retire early. I'm Josh Duncan, partner at F5 Financial Planning. If you would like to learn more about how we help our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com. Thanks for watching, and I'll see you in the next video.